disappear in the wind. Wall Street's a jungle, lions on the prowl, but the king of the jungle is old Daddy Powell. Old Daddy Powell, old Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Old Daddy Powell, don't bring me down. The numbers are flying, red, ink, and green. For some it's a nightmare, for others a dream. DJs are crying, theories disavow, bending the knee to mighty Daddy Powell. Oh, Daddy Powell, oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down. The bulls and the bears are locked in a fight. Who knows if we'll feast or starve come the night? With a glance at the screen, I let out a howl when I see that old motherfucker, old Daddy Powell. Oh, Daddy Powell, oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down.
I hope you guys are ready. This is going to be the most important day until probably the next most important day. But please put on your safety goggles. You never know how this is going to go. I don't want anyone losing an eyeball on this. We gotta, hey, take it a little bit more seriously. I think there's a lot of people on the internet right now screwing around, not really understanding how impactful this event is about to be. And I need to be the voice of reason, the voice of caution to get everyone ready. I'm seeing some people call for me to throw on my astronaut suit. I cannot. I have to wear my lucky shirt today. If there were a day to wear your lucky Buffalo shirt, it would in fact be today. So I'm wearing my luckiest of all shirts, and I'm doing everything I can in my particular power to stack the deck in our favor. To stack the deck in our favor. Captain is speaking. Ladies and gentlemen, this is your captain. We will be taking our seats shortly. Stewards, please sit down because we will have a liftoff in about 10 minutes. All right, I want to get everyone ready. My job here is to not only land this metal bird from these beautiful skies safely, but it's to give everyone a little bit of a more context for what in the world is going on. So let me do my job and you guys do your job. So first thing is first, you still have time. If you want to do the 50-50 strategy with Apex, granted, you now only have 11 minutes, so like hurry up. But if you buy that account, don't forget to use that code Goonie for 80% off. You can pull it off. You buy one account, great. You buy a second account, great. At 1:59 and 55, 56, 57 seconds, you set up an ATM strategy beforehand. One, you go long in max contracts. One, you go in short. If it's on a 50K account, you should be going for, I believe, 64 ticks, whatever 16 points is. Yeah, 64 ticks. That's your profit target. Your risk is just some astronomical number. Most likely you're going to pass one. Most likely you're going to fail one. Is this a guaranteed strategy? No, but the odds of passing at least half are going to be pretty high. So pinned to the top of chat in the description of the video. And then obviously throughout all of this, we are doing nothing but deeply monitoring what in the world is going on with options flow. So if you want to check that out, obviously shout out to Spot Gamma there. Don't forget, you could get a fat 80% off. So shout out to those guys. And I figured I might as well do it now because there's a very, very good chance I forget about it as all pandemonium is about to break loose. So here's a little look-see at the market. Kind of drifting down. From 1250 to now, we had a decent pop, especially in the Nasdaq there. Bitcoin got going for a second, up almost $1,000 at one point. The Russell was looking great this morning, and then it got clapped back down to 240. Surprise, surprise, a giant gamma level. So right now things are quiet. I would say the overall market is a bit bearish, but it's only a time. I mean, the SPY's down 0.2, the Qs are down 0.4, the Russell's up 0.6. All of these numbers can be amplified or completely reverted in a mere minute. That's how impactful this announcement is about to be. So get ready. Not only are we probably getting our 25 bips rate cut, which right now, let's see what Poly Market is saying as we're a couple minutes out, 93% chance of a 25 bips rate cut and a 6% chance of a 50 bips rate cut. Those are the odds of now, so pretty sure that we're getting a 25 bips rate cut. But what's uniquely exciting about this, beyond the fact that we're getting our first rate cut in almost an entire year, is you're going to notice that when you come to this, you could do it yourself, federalreserve.gov, come to the Fed's official website. You're going to notice that on every other FOMC meeting, every other one, you get projection materials. They skip one, projection materials. They skip one, projection materials. So we will be getting that this time around. This time, September, we are getting more projection materials, as in all this, it's technically the summary of economic projections. I'm telling you, if you're trying to hit on a baddie at a bar and you want her to like converse with you and you want to show her how smart you are or how awesome you are, you just got to start bringing up this SEP. Be like, hey, did you see that last SEP? I'm telling you, I can't guarantee anything in the market, but I can guarantee things in the world of dating. And one thing I could guarantee for you and your success at dating is bringing up the summary of economic projections. If you start spitting out facts of the SEP and you're like, oh, did you see how the dot plot got altered? Did you see what happened with the unemployment expectations for 2025, 2026, and for the long run? It works. It works, it works, it works. So I'm telling you, memorize this. So anyway, this is the last one we got was June 18th. And what's so important about it is they give you the recent projection. So this time around, it's going to say June projection, and then it's going to give us the new one. So right here, it's going to say 3.1%. Then are we going up? Or are we going down with respect to the PCE? What about unemployment? They were expecting 4.4 last time. They upped it to 4.5. So now the base is 4.5. Are we going up? Are we going down? Same thing with GDP. And then from there, if you keep scrolling, eventually you get to the all exciting dot plots. And that's where it's going to be fun. Because now that we have a little bit of a new composition in the world of the voting FOMC members, we have a new governor, because remember, Kugler stepped down at the last one. We're going to get their ideas of where do they see inflation going? Where do they see unemployment going? We're going to get all these expectations. So beyond the fact that we're getting most likely our first rate cut in almost an entire year, today it's going to be announced at 2 p.m. So we have about 5-6 minutes. From that moment, then we're going to be able to dive into the SEP. This also comes out at 2 p.m. So today, eventually this will load here. It'll be like right here. There's going to be new projection materials. It'll look like this. And you could just click on PDF or HTML. It'll pop up right here. Once again, this is on the Federal Reserve's website. You're going to be able to dive into that. And right away, that's what the market's going to react to. And then 30 minutes afterwards, we're going to be able to listen to Powell. Going into this, we're getting a little bit of a reprieve. We were selling pretty decently. And now we're seeing a bit of a pop. I'm excited for it. I think you should be excited for it. I was talking to ChatGPT, and ChatGPT gave me a 65% probability of IWM going up. Now, does ChatGPT know what it's talking about? I have no idea. But the fact that that clanker is backing up my own bias, my own positions, I do have Russell calls. I'm pretty stoked about it. I'm actually very, very, very stoked about it. So, folks, there's certain times to mess around, and I get it. Sometimes I am guilty of promoting a comedic atmosphere, a little bit of levity, a little bit of, hey, there's that really good looking Model S guy who doesn't take life too seriously. And I get that. But there are certain days that we need to approach the market in a serious manner. And this is one of those days. So all jokes aside, please put on your safety goggles, hat, shirt, pants, belt buckle. Make sure you secure your socks because we don't want to knock those off. And I get it. I know this is a little bit more of a serious tone than I normally strike. But folks, it's about to rock here. It's about to rock. Are things going to drop after the announcement? If anyone definitively knew that, we would be billionaires, brother. That's the whole point of that, is we are watching to figure out. That's why we're all getting this little dopamine rush right now to find out if we're on the right side of a binary event. If anyone definitively knew, well, we would already be trading at that value. Like, that's the whole point of trading, is trying to predict what is about to happen next. Literally no one on this planet knows what's about to be going on. Secure your socks, bitches. You know exactly what I'm talking about. All right, before this all breaks loose and chaos ensues, if you guys could help me out, murder the like button, destroy it, smash your mouse, smash your keyboard with your mouse, then take your mouse and smash your keyboard with it, smash them against each other. But as long as you're hitting that like button, that's what matters. Let's make this the biggest. Let's make this the best. Let's dominate the live streaming of this FOMC event. I don't think that there's any other streams that are really as, cautious and conservative as I am for your own physical well-being. So by that alone, there should be more people in here because we are obviously the community of extreme safety, as you can tell from our flight materials here. Oh, I'm nervous. What are we? I'm now at this point, I'm just rambling. Smash or pass? Well, smash and pass, but do it both to the like button. Dude keeps breaking my mouse. Hey, it's worth it. It's a worthwhile sacrifice. All right, I just want you guys to know that I do have this ready. He's going to be live. It's above my head right now. I'm ready. I'm prepared. He's going to be going live at 2:30. But in the meantime, they are probably going to be bringing on our boy Rick Santilli. And I would feel horrible if I ever cheated you guys from 1 second of our boy Rick. So I'll turn this on. I know you guys can't hear it yet, but I'm prepped up. As soon as our boy Rick comes on, of course, I'm going to let you guys listen to Rick. I would never keep that from you guys. All right, let's get ready. Here's everything. Here's the SPY. Here's the Qs. Here's the Russell. Here's Bitcoin. We could check the dollar. We could check gold. It's all about to get a little wee bit crazy. Results come out at 2 p.m. Not only is it going to be a 25 bips rate cut, but we will be getting an update of the summary of economic projections. It's going to say projection materials. It's going to be right there. That's what we care about. That's what we got to dive into. And I guess at this point, what's everyone's best guess? Bullish or bearish? My financial health is in your hands. Dude, everyone's getting a little jittery, man. Myself included. All right. I don't want this white box anymore. I'm deleting it. It's on you if you haven't already memorized where it is. Let's get to the 15-second chart. The ever so trusty 15. We're already pinned to 6,600. 1 minute to go. You got to vote now. Are you bullish or bearish? If you vote after this, it does not count. Uh-oh. Someone leak it? Mag 7's doing nothing. SPY is starting to pick up. Did someone leak it? Uh-oh. Oh, where are we? There are going to be dissents. We're 20 seconds out. You can't stop this momentum, folks. You can't stop this momentum. It's all right. Here we are. 10 seconds. Count her down with me. Folks. Buckle up, Buttercup. 5, 4, 3, 2, and 1. Which way are we going? The party's on. Oh, $1 higher. Instantly pop. Hello. Oh, Jesus. That's a tough one to swallow.
4.25%. New Fed governor and former CEO, current CEA chair, Stephen Myron, dissenting in favor of 50 basis point cut. The median Fed official looking for 2 more rate cuts this year, but just barely. I'll get you details on that in a second. The statement importantly says the balance of risks have shifted. Downside risk to employment has risen. Job gains have slowed. Unemployment has edged up. And economic activity has moderated. At the same time, the statement does note that inflation has moved up and remains somewhat elevated, but clearly the Fed favoring the concern about employment here over the concern about inflation. It says uncertainty remains elevated as well. On the rate outlook and the so-called dot plot, some really interesting movements here. As I said, the median Fed official forecasting 2 more rate cuts this year, but just barely. There was massive disagreements among officials on the rate outlook for 2025. Very unusual with just 2 more meetings remaining. Let me give you the data here. One official doesn't want to cut at all. There was no other dissent in favor of not cutting today, but one wrote down the current rate or the previous rate as their
these
dot.
Are good numbers.
6 want no more cuts after this one. 9 want 2 more cuts. And one official, I guess we can guess who it is, wants 5 more quarter-point cuts this year, or 125 basis points, bringing the Fed funds rate down below the median neutral rate. So there's a big-time dove on the committee.
Move down.
I think the committee at the headquarters here will have some fun figuring out who exactly that is. The median wants 1 cut in 27 and 1 in 28. So I'll give you the numbers now. 3.6 is the median forecast for this year on the funds rate, down from the current of 4.125. So that's 2 cuts. 3.4 for 27 and 3.1 for 2028. A little bit more on the economic outlook. Core inflation unchanged. The outlook for this year at 3%. Unemployment unchanged at 4.5%. GDP pushed up a little bit to 1.6 from 1.4. 5 members want to go below the 3% neutral rate in 2026. That's up from 2 in September. So they're looking for a little bit of stimulus down the road next year in the funds rate. 6 want to do so by 2027. Brian, I'll send it back to you.
Give us Rick.
And the smart people around the table there to make sense of all this.
Well, give us smart person down there in D.C. too, Steve. Should we assume that it is new Fed member Stephen Myron that is calling for the 5 quarter-point cuts over the next couple of meetings?
This was my speculation leading into this, and that's what I think it is, Brian. I think it's Stephen Myron
V-shape right there,
basically doing the president's bidding, calling for very sharp rate cuts immediately. I guess that would be, in order to get there, you'd have to have a 75 and a 50 from here. So one of the remaining meetings would have to be a 75, one would have to be a 50 in order for Stephen Myron's outlook, or the person whose dot this is, their outlook to be accurate.
Yeah, that dot, as they say, is kind of like this Canadian reference, the yellow knife in the Northwest Territories, kind of way up and out there. Steve, stick around.
There was a joke, Brian, there was a joke among one of the Fed reporters here that we were going to have to get a legal pad to get the dot plot together. It'd have to be a longer piece of paper.
I love that. You go from the 11.5 inch to the full 14. I'm old enough to get that reference. Steve Leisman, thank you very much. Let's go back now to our esteemed panel. Steve is still there. We still got to look through it. By the way, I'm trying to recycle the
We're almost going
internet
for that
so I can compare
right
the
now.
two. Francis, your immediate take on this decision?
Well, hearing about that dot plot, maybe I'll come in defense of the dot plot. There'll be a lot of comments about this being very political in nature, but this wide dispersion in views on this Fed.
The Fed, I thought the Fed wasn't political.
Whoa, motherfucker.
It's independent. Let me just say, because there's going to be questions about this, that there is a lot of confusion about the state of the U.S. economy now. It's not clear how much should the labor market truly be weakening. When will tariffs come through?
And
some of this dispersion we might be seeing in dot plots, some of it, not all of it, may very well be a reflection of the confusion of this economic moment. So we have to be careful about taking any headlines about the median dot here from what I'm hearing, because we have huge dispersion within Fed members. This is going to call more attention into absolutely who is going to be at the Fed and who's going to be leading the Fed not too many months from now.
$2, brother.
I think this is actually really important that there was only one dissent. Because what that tells me is that even though Governor Bowman, Governor Waller may want the job of Fed chair, they're not willing to go against the consensus of the Federal Reserve in order to get that. I think that is a very, very positive statement. So, I think, Jay Powell is Mr. Consensus. He wants to get consensus. Clearly, he talked to everybody before this meeting. And to me, the fact that they're not going to fall over themselves to say 50 basis points now, even if they want more Fed easing, I think that's a very positive sign.
There's very few things
because
that
it says
make
the
a
Federal
grown
Reserve as an
man
institution
cry, but this
regards
is
its
one of
independence
them.
as tremendously important, and they're not going to fall over themselves to do what the administration wants right now. And I think that's a very positive sign.
But our job, Jim, here is to look ahead.
Oh,
and
dude, the
if
Russell.
we are to assume that Stephen Byron or somebody else may become the next Jerome Powell, and that person is incredibly dovish, they want to lower rates, that maybe they are not entirely
Spit
apolitical.
in my mouth.
What does that mean for bond markets? What does it mean for stock markets?
So ultimately what we have to think about is the framework that the Fed is working through, which is the Phillips curve. So effectively,
what is that?
So the Phillips curve is a relationship between unemployment and wage inflation. So if the unemployment rate is going up, wage inflation,
are they not
and therefore
talking about my
consumer
calls
inflation
right
is
now?
likely to stay relatively low.
How the fuck
if
are
the
they not talking
concern
about it?
is that the labor market's going to weaken, then they are very likely to be able to say, I'll look past 3% inflation today because it's not going to be a problem because the unemployment rate will be very high. So therefore, we might as well cut. That plus the balance sheet, which I mentioned before.
I got
what it
calls
means
for
for markets,
October,
though,
and I got
is
calls
that
for
you're
Friday.
seeing now wage inflation stay relatively low and likely to stay low, which means that margins, profit margins, are likely to be higher. You're already seeing productivity start to rise. So essentially, as I tease through these statements and these numbers and everything else, what this is telling me is that productivity is likely to start to move higher into 2026. It's already doing so in 2025. That means markets can support a higher multiple, and it's bullish for the equity markets in that sense, because higher productivity means growth with relatively lower.
Okay, speaking of the equity markets, a couple things I want to quickly hit and then get reaction to it. The macro, the bigger markets, not moving a whole lot. S&P 500 up 0.1%. Who cares? What is moving is the small caps, the SML small cap 600 index. We don't talk about it a lot. It's up 2%. Here's why I'm talking about it, Francis, because small cap stocks, domestic American companies, almost entirely all their revenue is in the United States.
Yes,
those stocks
brother.
tend to move at the later end of a rate cut cycle. So I want you to comment on that move as well. And here's the other news. The 10-year yield didn't move at all. It's at exactly 4%. It moved down 1/100th of 1%. In other words, if you're out there looking for mortgage relief, you're thinking, let's wait and buy a home because mortgage rates are going to come down. The bond market is saying you might be out of luck.
Well, you have two issues in play here. One is that this market already priced in pretty significant easing from this Federal Reserve. So today was just meeting the expectations already in the market. You're going to have to out-ease those 5 cuts that were already put in if you want to see additional support coming through. But the second is, we talked about it on the show before, we've got fiscal dominance in play and that long end of the curve where mortgages are more tied, in fact, fully tied, far less sensitive to what the Federal Reserve is doing and much more to what government is doing and what Washington is doing. So we may want to pay attention more to shutdown risks, budgets coming through. If we want to focus about mortgage rates than we do necessarily the Federal Reserve.
Gary Cohn on CNBC earlier today said something very, very smart. Says a lot of smart things, David. But one of the things he said today was that we've got to remember the Federal Reserve, this rate call that we're talking about right now, the reason that we dragged you all to New Jersey, this is the overnight lending rate. It's like basically tomorrow. What our audience mostly, what JP Morgan's client base mostly cares about is what happens down the road. And the longer-term bond market isn't moving.
Right into this.
But this is actually good news because our great fear, I think all of us, is that the Fed becomes political, they cut short rates too much, and everybody says, you know what, we're off to the races in terms of government debt, we're off to the races in terms of inflation. That would cause the long-term rates to go up.
But we already did that. That's exactly what we did in 2020 and 2021.
We've got a 4% long bond 10-year yield. That is not...
Shut up, nerds, dude. Hot take. Write this down. Matt Kohrs' hot take. For you to be able to talk on financial media, especially on a live show, they should force you to have at least 10% of your net worth on the line in a short-term degenerate bet because I need more energy. I need more enthusiasm. These are the kind of people who are already perfectly balanced in the S&P 500. And in reality, they did not have an emotional tick up or down because of this news, because they're not going after it. They're not putting their balls on the line. They're not YOLOing.
Connection lost.
Shit. They're not YOLOing Russell calls right before. Come on, Russell. You gotta hold. You gotta have support here, man. You gotta get these magnets, dude. There's no love. There's no love for the game. That's my big issue. Is these guys unbothered? They're like, rump. Like they could have been like, yeah, it's 75 bips. Yeah, it's this, it's that. Dude, they could have said whatever and they would be the exact same right now. They'd be like, yeah, maybe. I don't know. Like they don't love the game. They don't love the game, folks. They're not in it for the love of the game, which is offensive. Well, the Qs are already giving way after taking out yesterday's low, really ripping all the way back up to the closing value. It's now getting smashed as the Russell is holding, and I smell the start of a rotation, folks. I'm smelling. What's that? Is someone rotating? Is someone rotating that pig on the spit right now? Is this, do I sense the subtle smell of a fall rotation? A little bit of a September FOMC rotation? Is that what I'm catching in the air? Is my olfactory senses, my olfactory system, is that picking up the subtle whiffs of a rotation? Do you guys smell that? Well, clearly people are moving money from tech into small cap. And I'm sensing, hey, you know what else we should check? Dude, I need this to fucking work. Come on, support. What's the point of paying for these emojis if they don't do shit to price? Anyway, I digress. Here is a look at Bitty Bitcoin. We had a pump overnight. We gave it back. We almost pumped on that. And now no one knows what the fuck to do. What about gold? Gold almost hit an all-time high, did hit an all-time high. Dingity ding 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 for all my gold bugs in the audience. Congrats to you. I like it. It's you know how we refer to like the oldest profession of time, ladies of the night? I like to think of gold as the oldest investment of time. So it's tried, it's true, it's been around for thousands and thousands of years. And I guess it really hasn't stopped because dingity ding 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 just hit a new all-time high in gold. Unable to reestablish connection. Panic. You know, when it says things like that, does it want me to panic? Or is the system itself panicking? They don't really make it clear. Like, is it panic, exclamation point? Like, panic! Or is it panic, interrogative? Like, panic? Or, like, they don't really give the vibe. When it says panic, it doesn't really let you know. There's more to the story, is all I'm trying to say. So anyway, maybe we should panic. Maybe you should. I don't know. Anyway, I digress. The dollar is getting its teeth kicked in. The dollar is fucking plummeting, brother. Dude, hard assets are going to rip. How's silver? How is silver? Silver has to be pippity popping right now. Is that an all-time high? Silver also. Wait, hang on, let's go to the weekly. No, it's not an all-time high. Apparently, we hit that high back in 2011. But we're hitting a recent high, giving a little bit back right now as gold is hitting an all-time high and actually seemingly holding there. Folks, hard assets are going to rock. I mean, equities, also assets are going to probably do well. What's going on now? I'm getting another alert. Oh, fuck, we turned. Uh-oh, SpaghettiOs. This is why you have to... Dude, the options just started dumping. Dumping right there. Mag 7 dumped. SPY getting dumped on. Longer dated puts are being bought. What the fuck? Holy guacamole, Batman. It's speeding up. I guess when it said panic, the tone of that panic was panic. It wasn't panic. It was definitely, I'm now starting to sense that this was panic with a exclamation point. Dude, Bitcoin's getting rocked there. Dude, even the Russell, it wasn't holding up. It wasn't, dude, look, options are fucking getting murked right now. Murked. Uh-oh. We gotta switch it. Hang on. I'm prepared for this. This is what you get in such a high quality show. You get a producer and a performer and a host who is prepared. You guys probably were sitting there and you're like, Matt's so unprepared. Why is he still wearing his green glasses? It's not even green anymore. It's not even green anymore. Well, joke's on you. This isn't my first walk around the block. Your boy is prepared. Your boy is prepared. Wow. The Russell's holding. That got smashed, brother. Look at that. Someone unloaded into it. Someone look at that turn. We went from positive 600 million in Delta Notional down to a loss of 1.2 billion. That was a $1.8 billion swing in Delta Notional value. What the fuck? We just are ripping through these levels. I guess gravity wins out. We started off at 6,600, pump of $2 just to vomit 30. And this is where we were earlier today. Maybe buyer stepping at this point. Holy crap. Holy crap. Well, I guess people are starting to digest this summary of economic projection. So this just came out. It comes out every other FOMC meeting. And this happens to be one of those other ones that we actually get it. So for those of you, if you're just joining right now, we got a 25 bips rate cut. That's the TLDR. Is exactly what the market thought would happen, happened. 25 bips rate cut. What we're currently waiting for is for Jerome Powell to take the stage, to give his prepared remarks, and then to answer questions. What the market is going to be attempting to glean is he hawkish or is he dovish? Is he optimistic for maybe another 50 bips, maybe another 75 bips by the end of this year? Or is he saying, it might just be 25? So that's kind of what we're all on the edge of our seat for. But in the meantime, we got this. So when it first came out, and this is most likely what the market at first reacted very well to, this initial gigantic pop to the upside, most likely reacting to all of this. The last time we got a summary of economic projections, the last time we got this SEP is in June. June prediction for GDP, 1.4. They now expect our GDP to go higher. That is good. Economic growth. They thought 1.4. They're now updating it to 1.6. They don't think that that trade-off is going to hurt unemployment at all. They thought 4.5, now at 4.5. So higher GDP, same unemployment, and inflation the same. PCE, they thought 3%, we're now at 3%. And what's actually kind of interesting is if you fast forward to next year, they increased it a little bit, but then they also decreased unemployment. And they actually also increased our GDP for next year. So at this point, we can consider 25 and 26. So for GDP, we have GDP up, unemployment the same, down, inflation the same, and up. Not the biggest fan of that particular print. But for core PCE, they actually also increased from 2.4 to 2.6, but they kept their 2025 prediction the same. And then last but not least, arguably actually massively impactful right now, is how they altered their Fed funds rate. In the June meeting, they thought they were going to stay between 3.75 and 4. Remember, they're going to cut it in half because it's in 25 bips increments. Now they dropped it. So that's now between 3.5 and 3.75. So that's a win there. They are dropping. Their expectation is one more cut than they thought back in June. In terms of next year, same thing. They're like one cut lower, and then pretty much the same thing here in 2027. So from June until now, the body that makes up the FOMC, the Federal Open Market Committee, as a whole, their base assumption is a bit lower. So that is good. And before, you were probably hearing on the news, like, is it political? Is it not political? That's all because of this right here. The old dot plot. FOMC participants' assessment of appropriate monetary policy, midpoint of target range or target level for the federal funds rate. So all these dots represent a voting member of the FOMC, as in they like legitimately have sway of what's happening in monetary policy. So basically you drop your dot of where you think it should be. So someone thought it was going to be between 4.5 and 4.75, as in raising it, because we were at 4.25. Now we're officially going to be at 4. So someone thought we were going up. Other people thought we were going to stay exactly where we're at. 2 people dropped it to the current level. And then you have a whole batch of people who are actually looking for another rate cut. So most of them coming in right here, happy to cut rates down to 3.5 to 3.75. So when Steve Leisman was on CNBC and he's like, yeah, a lot of them are now pricing in 2 more rate cuts, as in a 25 bips rate cut, most likely in October, and then another one in December. That is what we are seeing right here. That's all of these guys. And then the new kid on the block, Stephen Mirren, who was literally just confirmed to be able to vote. He was confirmed yesterday, coming in way lower. He actually voted. He thinks we should be down at 2.75 once again by the end of this calendar year. And just to remind you, we are now at 4%, as in he thinks we're going to get 125 bips cut from here. So that's the new kid on the block, kind of dragging the average value down, I suppose you could consider it. So that's a quick explanation of what we're seeing here. Overall, I would say this little table is actually really good. The only thing that I think is a bit concerning is they are expecting inflation to go up in 2026. They were thinking 2.4. Now they are raising it up to 2.6. So an increase of basically 0.2%. So that's the only bad thing I could see. All the other ones are either in line or actually an improvement. And I do, it is nice that they're expecting economic growth now more than they were for 2025, 26, and for 27. So that's a win. Unemployment is fine, actually a slight improvement. Inflation, a slight step backwards. Same thing with the core inflation taking out food and energy. And then in terms of the Fed fund rate, the average is dropping because of this new guy who he put his vote so low that obviously just that's how math is math. So that's the setup. This all came out at 2, and now we are basically saying, all right, what in the world's actually going on? You can see the market's been hella volatile. Big pop, big drop, big pop. And at this point, I'm telling you, you got to put on your safety gear. If you're not putting on your safety gear, you're asking to potentially damage your cornea, and that's no joke. Do you want it? It's like, it's equivalent to running around with scissors. You're not supposed to do it. It's the same thing as swimming within 45 minutes of eating. There's certain things you should do in this world, or there are certain things in this world you shouldn't do, and that's why we have rules against it. You don't run with scissors, you don't swim 45 minutes within eating, and you don't pay attention to an FOMC reaction without the proper safety gear. You have to. You have to. So here we are. I'm doing everything in my power to keep the markets up. I don't know if you guys are doing appropriately what you should be, but I mean, I put on my magnets, I put on my rock. I mean, I'm putting the market on my back, and honestly, I kind of feel like I'm doing this by myself. I feel like a lot of you guys are watching the show and you're thinking to yourself, oh, like Matt will take care of it. And it's like, you don't understand. Like, it's me versus Wall Street right now. Like, maybe fucking help me out. Get ready to switch classes. Dude. I'm a Boy Scout because if nothing, I am prepared. I'm ready to go. Dude, this one's not going to catch me off guard. Whatever happened to my data? Honestly, I should be done trading anyway. There's kind of like no point in me trading this because I'm already up 1.5K per account. I did that all before the FOMC meeting. I feel like I should just stop. But sometimes it's just so much fun. The captain says to buckle up, people. You guys better buckle. I feel like a lot of you think I'm kidding, and it's just, this is for your own safety. Oh, dude, I wish Bitcoin popped to like 120. I know many of us do. So tech is still getting pretty rocked. The SPY is literally pinned to exactly where we've been. The Russell is winning. The Russell is benefiting. So I like that. The only green thing on my watch list right now is the Russell, which is up 1.7%, and Apple, which is up 0.5%. Suspect. All right, we just now have a giant range to pay attention to. All right, let me map out this range so you guys know about the breakouts and the breakdowns. So honestly, as I kind of said early today in the morning stream, was thus far we've violently gone nowhere. We really, really have. We're getting pinned to 6,600. Technically, we're above it. I think if we start to recover above 6,611, you have a real shot of a new all-time high. We got very close to a new all-time high at 2:05 p.m. 5 minutes after that report came out. We were within spitting distance of a new all-time high. So it's still possible. I want you to know that we're basically just in halftime right now. All that's going on at this point is we got the Fed decision, 25 bips rate cut. And on top of that, we also got the SEP, which I just went over. Now it's halftime. We're all listening to Beyonce and Taylor Swift kind of rock it right now. And we're waiting for the second half of the game, which starts in 4 minutes. And that's kind of the boss level. That's when Jerome Powell, the chairman of the Fed, is going to come out. He's going to read us his prepared remarks, and then he's just going to get ambushed by all the analysts who are going to ask a bunch of gotcha questions, and we're going to find out what's what, who's who, and if the Bulls are in control or the Bears are in control. But overall, in the short term, expect choppiness, expect volatility, expect a lot of craziness. In the medium to long term, 6 to 8 to 12 months, Mystic Matt's market prediction, and please have a little bit of appreciation who you're taking this from. This is not financial advice. This is just me exercising my free speech and sharing my thoughts, but obviously I have no crystal ball. I think this is going to end up being extraordinarily bullish for the market. I think there's a real shot in the next year we are having a double-digit gain. Double-digit gain. Why you hate the Russell? It's up. I needed to go up more. I want to see 245. What do you mean hate the Russell? I'm the one who put the magnet and the rocket ship on the chart. What did you do? You're talking an awfully tough game for a person who's not done anything to benefit the larger Russell 2000 community. What am I doing? Scoff. What am I doing? What are you doing, buddy? Bucko? Pal? Mr. Miyagi? What are you doing over there? The fuck? What do you mean? What am I doing? I'm putting the goddamn market on my back. You guys are so lucky I hit the stair stepper every day. You guys are literally so incredibly lucky. My buns are made from steel, because if I were not hitting the stair stepper at hard, I would not be able to put the entire market on my back. I'd be risking scoliosis if I wasn't so dedicated to the religion of stair stepping. I scoff. I scoff at your comments. I scoff at your commentary. I scoff. Let it be noted in the official transcript of this live stream that the host, I, Matthew Maximus Kohrs, I have scoffed. I think you wrong, Matt. They cutting before their inflation target hit. They must see something cracking. Yeah, the jobs market, brother. Did you not see that revision of a loss of 900,000 jobs? I got my stops in up 8K. Congrats. 260 flights. I've never done 260. My max is 250, 250. I've never hit 260. I've never, ever done it. But one of these days when the Olympics comes calling, ring, I'm going to pick it up and I'll be like, yo, go for Matt. They're going to be like, Matt? And I'll be like, yeah, what's up? And they're going to be like, this is Jeff from the Olympics committee. And it turns out that stair stepping is now going to be an Olympic sport. And we need you to represent the best country in the world. And I'm going to say, Jeff, shh. Don't you worry, buddy. And obviously, I'm not going to hear it, but I'm going to sense that he's going to, as a grown man, he's going to do one of those quiet weepings where he's like he gets a little like choked up. And I will make our country proud. Not only for Jeff, but for all of you. for everyone who also is a red, white, and blue American, I will make you proud. I will die on that stair stepper before I bring home the gold. Actually, no, I shouldn't say that. That doesn't make sense. That means I'm going to die without winning. I will die on that stair stepper. Wait, what would be the right saying for this one? I feel like I'm kind of fucking it up, and I sense that I'm losing you guys in chat. I can feel the room pulling back from me. I would rather die than not bring home the gold medal. That's it. That's what we're gonna do. I kind of said the opposite of that at first, so that's very embarrassing. All right. Anyway, Jerome Powell
focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 0.25 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet.
Gamma support.
Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance.
Okay.
With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Jesus, we're giving it all back, brother.
Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, great. And then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank
you. You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that
as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it, but the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut. But the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Almost
Chairman,
a
Neil
rotation
Irwin with
back
Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college.
What a play, 50-point bounce.
And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things, but yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Ominous.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding? Well,
I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So, we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
Thank you very much.
All right, that was the Fed chair explaining why the Fed just cut interest rates by 25 basis points. Its first cut in a year. Chair Powell saying the balance of risks have shifted towards more weakening in the labor market. Much talk about potential dissents today. We got one from newly appointed Fed Governor Stephen Myron. He wanted a 50 basis point cut, and we're going to discuss that and more in just a bit. Let's take a look at stocks, too, as we enter the final stretch today. They are largely mixed. The Dow's been higher for most of the day, NASDAQ lower. It is the Russell that is outperforming today, about 1% or so from an all-time high. Also important to look at rates. The curve steepening, a little volatile there as well. The long end has been the focus. The 10-year went briefly below 4%, but you see now has risen above that, and we'll get into that as well. It's good to welcome you to Closing Bell today. I'm at DoubleLine in Los Angeles with Jeffrey Gundlach, the firm's founder, CEO, and CIO. It's good to have you, and thanks for having us.
Welcome to DoubleLine, and I calculated that we've been doing this, you'll be surprised. This is our 37th time that we've done this in relation to the Fed, which is, it feels like a lot less than that, but that's the way time goes, especially when you get older.
Yeah, and we've had a lot to talk about, obviously, in that stretch.
Yeah, it's been all over the place.
Yeah, give me your reaction to what you got today, to what the Fed chair himself called a risk management cut, as he suggests the risks have grown.
Yeah, I think the phrase of this press conference is challenging situation and no risk-free path forward. I think
boring. All right, folks. Here's the real TLDR. Whipsaw galore. Here's the 5-minute chart. So it all started at 2 p.m. A little bit of a ramp up into the announcement. They announced the 25 bips rate cut. People start looking into what the hell the SEP is. Then we bounce. Then we crater. We find support at the massively important gamma level right here of 6550. We found support right there as expected, and we ripped. And then this was what I thought was interesting. Right here. Either we're going to get rejected and puke back down, and then actually we started to recover instead, battling it out and trying to close green on the day. And that's exactly where I got calls. It was this reaction right here where I was long going into this, but more on the Russell. And I really would argue that's like a super strange reaction here over on the Russell. So now muted. And the way for a bit there, we saw like almost a rotation in a small cap and tech was getting hit. Now we're seeing the opposite. See how the Russell's lagging behind and tech is leading our way back up. So the whole situation is fucking nutty. But anyway, now that things have calmed down, I can kind of show you the insanity, which was today. I mean, dude, the Qs are going green now. The SPYs, what the fuck is this? Anyway, I punted my Russell position, and then I ended up picking the overall market, and I also picked up a little bit of Tesla as well. As many of you in chat were astutely pointing out, it was going green. I saw the breakout. I saw the technicals up here at 440. You guys saw me peak in this right here. I was like, okay, 435. I saw this 455. I saw this 470. So I was looking at the support at 410. I was looking at the support at 420. Started to do a breakdown here. And I was like, you know what? I don't mind risking 410 for the opportunity of 440, 450, maybe even higher. So I got into a little bit of Tesla. I got into a little bit of the overall market. Bitcoin's fuck Bitcoin, dude. This was a messy one. This was an absolute messy one. So it's kind of crazy in real time to see it play out, but what a dip, what a rip, what craziness we have going on. So I hope you guys got yours. I hope you heeded the warning of just chill, take it easy. You didn't have to really risk much. You just said you don't want to risk much because just the vol and the movement is so immense. So immense. But we have Tesla going green. I like that. CRWV is still catching my attention, even though it's moving nice intraday. That's a pretty solid recovery, but we still are waiting on that potential breakout. Do I want CRWV? Is this going to break or is it going to get rejected? I guess you could keep your risk pretty small. You could keep like a $10 risk. That's a nice. Is this the day or is it more appropriate to wait? This one's on my watch list. This feels like there's gonna be a move soon, and this isn't really a common play of mine by any means, but the setup, big push, pullback, lower highs, lower lows, knocking on the door. Is this third time going to be the charm? Is it going to break and rip? I don't know. Your guess is as good as mine. I see Bitcoin picking up a little bit, which it's not going to be the exact same thing. There might be like correlation there, but the risk reward, it's more of your risk is this recent swing. Your first reward is 150, potentially push all the way up to an all-time high. So it's more so that I'm captivated by the risk reward. Jesus, we are going. We are going. What did I do today? Well, it ended, or for a second there, it's looking pretty poor, but I think I did enough repositioning that I'm going to save my account a little bit. Golly, folks. Another FOMC day in the books. Quick question. How many of you were able to pass Apex on that craziness? I got a couple messages. I'm checking out Discord. I know some people in there. How many of you guys in chat were able to use the craziness of that 2 p.m. reaction? Obviously, it was the longs that hit. Raise your hand. This is your time to brag. What's the options flow on Tesla? Ripping. Dude, it is moving right now. It is moving. It is grooving. It's crazy. Yeah, that's definitely catching a bid. It's definitely catching a bid. Oh, man. Well, remember, Apex, Goonie, 80% off. I didn't trade on any of those in here. I just already locked in my gains this morning, 1.4K. Happy with that. Did that on 22 accounts. Did a little scalp trade on the other ones just to pass because I just need one more trading day. So looking good. These are about halfway to where they need to be. Technically, these Tradeify is already pro accounts, so I'm just kind of chilling with those. And slow and steady will win the race. Also, if you want to check option flow yourself, shout out to Spot Gamma, 80% off. Use that link in the description of the video. I'm watching Tesla a lot right here. I'm excited to see how this map updates, but a 435 breakout, we might be talking 450, 455. We might be talking some movement for sure. Apple's been looking strong. CoreWeave, I keep pitching it to you guys. I currently don't have a position. Palantir, I mean, my risk got hit, but I wish it didn't. My risk got hit when we took out these lows on that little fake out, but now it might just tilt me right back in. But as we took out 1, 2, 3, 4, 5 different lows, of course my risk was hit. And I feel like I got wicked out on that one because it's recovering super nicely. So that one seems like a bit of an unfortunate beat for me. If you white knuckled through it, congrats. I mean, that's awesome. But my risk was hit 1, 2, 3, 4, 5 times, taking out the low, taking out the low, taking out the low. So that's a bit of a bad beat, but hey, shit happens. Well, anyway, folks, that's what I have for you. Shout out to Spot Gamma. Shout out to Apex. I hope you were able to survive the craziness that was that FOMC reaction. And really the exciting thing, at least in my book, is going to be to see how this all settles tomorrow. I want to see the options flow update on Spot Gamma side and see, okay, how did people really position themselves in this? Because we had that pop, we had a gnarly drop, and at this point, an even better pop. I mean, the NASDAQ, we're seeing that inverse rotation. We're seeing like, holy crap. Holy crap. So the Russell was high flying, and then out of nowhere, the NASDAQ got saved somehow from the depths of Valhalla, and it is fighting back with fury, and it's doing everything in its power to close green today. Fascinating. Absolutely fascinating. Well, folks, like I said, I hope you crushed it. I hope you made a bunch of money. We will be streaming once again tomorrow morning, 9 a.m., bright and early. Excuse me. I hope to see you there. And remember, stick to your training plan. Don't oversize. Godspeed. Appreciate all the good vibes. Much love. Peace.